Welcome to the Second Bite podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Welcome to the Second Bite podcast. Have a really interesting guest today. Justin Hayashi is with me from New Engen. Justin, thanks for being with me.
Yeah, Todd, great to be here with you, and excited for the conversation.
Yeah, I got to tell you, I'm excited to talk because a lot of the people that we have on the podcast are guys that somehow got in the agency business, bootstrapped themselves, built it up, and then sold it. And yours is, I think, a much different story, right? You had a big success with your first endeavor at Zulily, built that to $1 billion business. I want to understand how that shaped your thoughts here. Because starting here, you didn't just bootstrap it. You went out and raised money and obviously had some kind of a clear intention about what you were going to do. Then you partnered with private equity, the good folks at Insignia Capital. Want to talk about that. Then you partnered with them and you did acquisitions along the way, and you're trying to fit them all together. So we have a ton to unpack, which I'm excited for. So first question, just for introduction. New Engen. What do you do and who do you do it for?
Yeah, that's a good baseline question. So in the simplest form, we're a digital marketing agency. We provide media strategy, media services and execution, buying capabilities. We provide analytics and measurement around those media efforts, and we provide content to deliver the most ROI with those media efforts that we deliver. And so that's the simplest form, full funnel digital marketing agency. As far as like who we service, we're really focused largely on mid-market enterprise businesses. And I know everyone defines that a little bit differently. So just our internal definition of where we draw the line is really kind of businesses in the 100 million per year revenue, up to billions of dollars of revenue per year. And almost entirely focused on consumer businesses. I think that's there are a handful of agencies that straddle the B2B and B2C ecosystem really well. We're not one of them. We're maniacally focused on B2C. We have attempted to dabble in the B2B space every once in a while, but it's just a different rhythm. And so we're obsessed over that mid-market enterprise B2C kind of ecosystem. And that spans everything from fashion, apparel, beauty, CPG, wireless and telecom to streaming, and kind of whole set of industries that we straddle across.
I've got a couple of these over my shoulder that the founder started with an investment from the outside so that he could start a business. Many of them, like I said, just kind of grew out of a job. Mm-hmm. So, and I think it's 2016, 2017 timeframe that you launched, and you took money right from the beginning. Can you talk about why the decision to do that and how that impacted the structure of the business?
Absolutely. And it's funny. I think in the intro you said like we had some clear intentions, and when I think about the history in our timeline, I think of it as a pretty messy history and timeline, one that wasn't as intentional as it might look from the outside looking in. And some of I'll start with a little bit of the backstory before starting the business because I think it's relevant. So I used to work at a business called Zulily, which you noted, e-commerce company, flash deal business. And so they were really focused on moms, babies, and kids. That was their tagline. So the mother consumer for their children, clothes, toys, hard goods, et cetera. And I used to work at Boeing before then, jumped into Zulily just because I wanted something completely different, something much more agile, faster paced. And this was early innings of Zulily's founding, kind of you call it year 2 or so. And what I loved about it was everything was digitally oriented. There was a lot of data and granularity and the ability to produce pretty interesting insights. And with that, a lot of value to be created if you could analyze and move quickly and move at a rapid tempo to drive value. So that business IPO'd in about 3 years, and then was public for about a year, and then got acquired by QVC. And I left Zulily about 4 months after the acquisition of QVC. It felt like big company again, and I was looking for something much more entrepreneurial. And so when I started New Engen, I actually had 2 other co-founders, and we had this. One was actually my boss at Zulily. He was the CMO of Zulily. The other was an engineer that worked on the checkout function at Zulily, which was a really important engineering function, as you can imagine. Those orders need to go through and process. And so he's a really talented, scrappy engineer. And we had this belief, colored by our Zulily experience, that one, there was a lack of data-driven, performance-oriented, accountable marketing services and technologies out there. And we had tested everything from agencies to technology providers and SaaS solutions out there in market during our time at Zulily, and felt that was a really clear gap that we could tackle. So we took VC capital really because we originally had this belief that we were going to build a SaaS company, a software solution for marketers and brands. And none of us had actually worked at an agency before, pretty ignorant on the ecosystem, had dabbled with agencies at Zulily, found them to be not really general. I don't want to say universally, because there were some great ones that we did work with, but generally speaking, none that stuck around for and endured the test of time and outgunned our internal team and operations. So we're less focused on agencies, felt technology was the more viable solution, hence the venture capital funding on day one. That led us down a road towards building SaaS solutions for about a few years. In lieu of not having a fully built out technology on day one, we had what was called a managed services function, which our clients called us an agency, and we kind of rejected that notion for the first few years.
Of course, you're a SaaS business, right?
Yeah, which is now exactly. Now it feels very silly to reject it, because that was absolutely what we were doing. We were providing strategy, we were providing data and analytics, we're finding media strategy, media buying, media execution, and then we also knew, that content creative was a really critical part of delivering outcomes on media. And so one of our first 5 hires was a designer, so that we could produce content to enable growth. And so the way I think about the evolution is the North Star hasn't changed for us. We always, we were brand side marketers. We cared about customer acquisition, LTV, ROI. We wanted to deliver that for clients. And we thought technology and SaaS was the way to do that. What we quickly learned is that services and strategy and analytics and even like navigating client organizations and helping them kind of coalesce around a strategy. There's a lot of like human touch elements that are really critical to unlocking customer acquisition, accountable marketing, accountable growth. And so while the North Star has been consistent, the way in which we pursued that shifted and evolved over time.
So I think about I'll put it this way. The group of folks that I know that invest in agency businesses don't invest in SaaS and vice versa. Yeah. SaaS investors expect a SaaS kind of return if we're going to, and I understand it's a high risk, high reward business. What kind of friction did that create with your initial VC group, and how did you resolve that?
Yeah. So, for the first few years, we really self-identified with our board, with ourselves, with our employees as a SaaS company. And so, right out the gate, first full year in business, 5 million in revenue, then went to 15 million in the next year, and 23 the next year. So we were,
of SaaS revenue?
Of revenue.
Okay.
Yeah.
Okay.
And so really, we called it just revenue. But if you really took a critical look at it, it was services revenue, it was agency revenue. But we really didn't self-identify that way. And so we didn't perceive or view that revenue as agency revenue. We viewed it as SaaS revenue, because that's what we were as a company. But the way in which we were delivering that was through human beings, through agency-like contracts, through a team that was using our technology. So it was leveraging the technology we built, but it was not self-serve. It was not SaaS. And so the way we justified is we were going to get there. And in the early innings, just to get traction and get revenue going, we were going to do this hybrid model. And so first few years, there was not a lot of debate around the type of revenue or whether we needed to question the approach or how we needed to scale the business. But eventually those things come to a head. And I think it was around year 3 or so, right around then, where we attempted to. Well, we looked ourselves in the mirror and said, okay, this is a huge services team that scaled quickly. Revenue's growing, customers are coming in through the door, which is great. And we had 2 clients that were using it on their own, and 100 plus clients that were working with our teams and wanting us to leverage the technology on their behalf as an agency. And so we took a significant push and an intentional effort towards building a self-serve solution, and said, what are the roadblocks to having a self-serve solution? What do the teams need to look like? What's the investment in engineering? And we ramped up our engineering efforts, our technology efforts, and even at one point created this sub-entity called Jove, because the business New Engen was known as an agency in market. And so we had to kind of create this other separate thing that was had its own domain, had its own website. And we took a run at that for, about a year and a half or so. And
2019, 2020?
Yeah, 2019, 2020, and then a little bit into 2021, but that was really tailing off at that point. And it was, just being blunt, unsuccessful. We weren't able to get traction. Even when we did get SaaS clients, and we did get some notable ones that we were really excited and proud to work with. So like Warby Parker was one. They were an early client of ours. Uber was a client for a little bit. And so good logos, good contracts. But even in some of those examples, like take Uber, they wanted us to use the technology, even though they're paying SaaS prices. So now we had to put services teams against that. Right. And then additionally, they, when Uber or one of these large enterprise companies asks for a tweak in the software or in the tech that you've built, you kind of have to say yes, especially when you're, year 3, year 4, and you're a hungry startup that's looking to scale and do big things. And I think naively we'd pursue these things, and we would put a lot of engineers on deploying a custom bespoke solution for an enterprise client. And then, 6 months later, 9 months later, the APIs change, or the way in which marketing and the platforms works change. And therefore, all that effort and R&D and investment we put into building that feature for that client basically was worth nothing. And so we learned the lesson, a couple times that way, that one, building marketing in ad tech SaaS is really difficult. I think there are actually very few that have been able to succeed and do that durably over a decade plus. And we didn't feel we were well positioned to be able to capture that opportunity in the way that we had originally thought when we founded the company. And so we had to make the hard decision of essentially repositioning ourselves as an agency. Started to study what an agency business looks like, again, because none of the co-founders, myself included, ever worked at an agency, and had to have some admittedly difficult conversations with our VC investors and our board of directors, but they were all very rational and just people that we'd also worked with at Zulily. So the 2 VCs we had, Trinity and August, both early investors of Zulily. The founders of Zulily were also investors of us. And so really, while difficult in the sense that we had to make a difficult decision, the conversation itself was really natural and all very kind of rational and pragmatic. And so we were able to get to the conclusion that, hey, this isn't a typical VC business. We're not sure we're going to get these SaaS multiples. A SaaS solution effort is going to take a lot more capital. And given where the business is at, where the traction is at, and if we think about the North Star of the business, an agency business model makes a ton more sense to pursue. And then when you start studying, this is called 2019, 2020, 2021, we're seeing the Power Digitals, the Tenuities, W Promotes out there taking private equity capital, getting much stronger, much faster, a lot more robust capabilities very quickly. We also had a belief that digital was changing or obviously had changed rapidly for the last many years leading up to that point, but that was only going to accelerate in the out years. And so this kind of conversation of organically building a bunch of capabilities versus taking the organic plus M&A acquisitive approach being a better way to build the business that we needed to build. We felt that private equity had to be introduced into the cap table and the investor set to be able to pursue our ultimate goal. So that's how all that played out, which is why I say it's a little bit messier than.
That's super insightful. Also, just for folks listening, Grayson LaFrenz, who is the founder of Power, has been on the podcast. If you want to check him out, Mike Mothner, who's one of the founders of W Promote, also been on the podcast, so you can listen to him if you want to go down a rabbit hole or two. You decided then we're going to go find. This is a private agency is very much a private equity business, right? It drives good margins, good opportunity for consolidation and growth. How did you think about that? And having the cap table you did, with you not being the majority owner, you personally, how did that impact your ultimate deal with Insignia and your selection of who your partner is going to be?
So, I think definitely definitely impacted that decision-making process, but ultimately I think got to where at least my preferred choice. And we didn't go with the highest bidder, which I think was my concern potentially with a a board of directors with meaningful stakes in the business, and therefore they care about the outcome. And so it wasn't I like this company or I like this private equity firm, I'm going to go forward with it. It was very much, hey, here's a lot of analysis of like, here's the landscape of potential buyers. Here's what we think are the comparable benchmarks of what our company should be valued at this point in time. Here's the various offers we received, the pros, cons. And the fortunate thing is all of the investors, including my co-founders, were willing to roll over and also did roll over a portion of their ownership stake into the new structure. And so they also cared about and continue to care about the future of the business, not just that exact specific point in time. And I also personally rolled over the majority of my stake as well, because I'm what I felt was a massive opportunity ahead. I didn't want to leave that on the table. So because of that, we were all kind of definitely aligned towards a longer term vision, and therefore be able to make a longer term goal. But it is a lot of discussion, and not everyone's going to see things the exact same way. And so a number of meetings, a number of alignment conversations. But in the grand scheme of things, I think it was a fairly smooth process. I think it could have been much worse when you say you've got 4 different financial investors, 2 different co-founders,
and different objectives, right?
Yeah, different objectives, but overall, we all locked in pretty quickly with a couple of things.
Is there anything specific to Insignia that you think stood out that gave you comfort that these guys can help me get to the promised land, that also made your investors and board members feel comfortable?
Yeah, so it's interesting. So when we ran a process, when you as these processes tend to go, you have a bunch of these kind of virtual conversations, then you have called 10 to 15 dinners, and then you have the in-person meeting for 4 to 6 hours the next day, and so we did a lot of those, and so you get a pretty good purview into the type of personalities, the experience of the firm, the shared vision, the values. And Insignia was actually our very first dinner and in-person meeting. And so I remember talking with John, who's our president, and really the two of us were going to carry the business forward. And so we were the ones meeting with all these. I was
going to ask, so no board members or investors in the management presentation?
Correct. Yeah. Yep. Exactly. Just myself, John. I think it was just me and John actually for call it almost every single one of those meetings, and then my chief of staff as well, Michael. But yeah, we basically took that first meeting. We're really excited coming out of dinner and the meeting with Insignia. They had a really clear-eyed vision of what the business could be with their support that completely overlapped with our vision, and so that was one, just great, good to have that in the column there. And then additionally, values-wise, they were people that we could see ourselves working with. Now, obviously, you don't want to jump to those conclusions off of one meeting, but that was reinforced through multiple discussions after that initial dinner, through diligence, and continues to this day, which we can talk about in a little bit more detail. And then additionally, in terms of like the M&A philosophy, the acquisitive approach we wanted to take, they also had studied the landscape, had a perspective on it. So they weren't just, here's the dollars and get after it, but they had actually a sharp perspective, a well-grounded perspective on the industry and how M&A can enhance our business. And then the experience of having done it with a number of business services. And so it was a easy slam dunk coming out of that first conversation. We had a number of other discussions like that. And there's not to say there are actually quite a few good ones as well. And we've talked to some of the strategics, but Insignia was a huge standout for us in terms of kind of the really important variables for us, and the one we wanted to go with from the beginning all the way to when we made that decision. And so it was really kind of articulating the value proposition very clearly to the board. And then, the board also has all these kind of third-party tools to look at fund returns and whatnot. And Insignia's, if you kind of do some research on them, they've done really well. Fund 1 was a major success. We're part of Fund 2, also off to a good start. And then they just closed Fund 3 very recently, but they're fairly successful, although not, multiple decades of existence, but in their early innings, and call it, relatively short tenure relative to the industry at large, very successful, or at least in that kind of top quartile, top decile of PE firms.
And you mentioned that they weren't the highest bidder. How much of a differential percentage-wise? You got a few offers.
Mm-hmm.
What was the percentage roughly from your highest to your lowest?
Yeah. So, gosh, you're testing my 4+-year-old memory here, but 15% or so between the top bidder and them. So not like it was double for the other one,
Sure,
but meaningful. Where it's not nothing. And
do you think it's helpful? It's 15%, but then we got to slice it up with the investors and the board and the founders. And so the actual impact to me, especially if I'm rolling over, is not as important today because of its size that I'm willing to bet more towards that second bite. Did you have any of that dynamic?
Yeah, I mean, I was pretty clear-eyed from the beginning of the process that that transaction was not my moment, or that I was shooting for. I had a really strong belief that the business could be something, a powerhouse in the industry, something much more significant than what it was at that point in time. And so my eyes always been on building something long-term that's extremely durable, much more scaled out. So whether it was 5, 15, 50, I was pretty dead set on something that was going to align towards long-term growth and long-term success versus an exit in a short-term horizon. So I don't even think about the difference in those prices. I was really dead set on who's the best partner that can enable that ambition to become reality. And Insignia was by far number one for us. And I know that sounds corny because there are current investors. And so, there's probably some inherent pressure to say that, but I actually genuinely believed it. And I still do. Like, they've just been exceptional partners for us. And so
that's great. And to be fair, not the only person I've heard say that about Insignia.
Yeah.
Is there a difference, since you've experienced both, between the relationship you have with a VC board or owner and a PE board or owner?
Definitely. So yeah, I mean, the one dynamic with, take VC as an example, you mentioned this, that they're these numbers might not be exactly right, but generally speaking, they're trying to get a home run on, call it 1 out of 10 or 1 out of 20, right?
Right.
And they're going big. They have huge ambitions, and so they're down for the investment and scale and whatnot. And then in private equity, I think you're trying to win every single time, and you're taking less bets, but you're going deeper into each bet. And so the interaction, the engagement with the board, with my VC board as an example, was way less frequent than the bi-weekly one-on-ones I have with the folks at Insignia, and then the M&A pipeline discussion we have on every other week, and then the financial reviews we have. And so it's definitely a different level of engagement interaction, but it's not just to report out the weather. It's to talk about the business, strategize, and figure out how we can create value and continue to kind of grow in the next horizon. And so much more engagement, which is actually what I was really excited about with private equity as well, and understand like why VC doesn't work that way.
Let me follow up on the M&A pipeline, because there's, I think some people that envision, I already know a bunch of groups, and I think I might, that I think would fit, or PE is just going to show up one day and say, Justin, we're going to buy this company. Can you talk about what it is like with Insignia, and do you start from a whiteboard and say, where's the puck going to be? Where are we weak? What do we?
Yeah.
Go ahead.
Yeah. So, we every quarter we have a board meeting, just like we did with a VC
on
investor.
Screens or face to face?
Face to face. Yeah. So face to face, we're meeting in a room, and we're sending, the 130 slide deck, a few days in advance. They read it, and then we don't go through the deck. We just talk through the most salient kind of critical topics and agenda items. In that deck, we always include a perspective on M&A and where we think the critical capabilities are that we'd like to bring into the business. Sometimes they're accelerating existing capabilities. In some cases, it's about net new capabilities. But we're putting together a thesis, and so it's not just saying here are the capabilities, but it's also like why we believe it's relevant. Who are the customers that have told us that these capabilities would be accretive to their engagement with New Engen? What we think are the industry tailwinds or headwinds in that space. So pretty thorough review and analysis of that to ensure that, if we're going to put serious dollars behind an acquisition, we better do the homework and be serious about our opinion on that. Having said that, yeah.
I'm sorry, but who's going to then, does Insignia help with the hunting and sourcing of those prospects, or you have to come with your own ideas?
Yeah, they absolutely help. So they've got a team that is fully dedicated towards outreach and connecting with a number of agencies and businesses that sit under their portfolio or adjacent to their portfolio, including ours, and so they are working with us and refining that hypothesis of like what exactly makes sense for New Engen, and then go after that list, and then additionally, obviously connecting with great bankers like yourself, Tom, where you get a lot of deal flow, really interesting deals as well, and that are really relevant to us. And so making sure that we have warm relationships and cordial relationships with top bankers in the industry, and so that we're top of mind when these opportunities come to market, that we're at the top of the list. So they are definitely helpful from that perspective. Having said that, I also try to stay very kind of lean forward in whether it's at conferences or just networking in general with my peers, both in terms of just trading notes, but also to on the prospects of if someday we do have the opportunity to combine forces and do something greater together. I want to be at the top of the list, or at least in consideration. Mm-hmm. And so it is heavily reliant on Insignia for sourcing, and then diligence is a whole separate beast that they're extremely helpful.
Yeah. So maybe as an example, since Donut was your most recent, can you walk through? How did that get on your radar screen?
Yeah.
Were they running a process? Did you knock on the door? Take me through the whole thing.
Wow, I hope you enjoyed those comments from Justin. Anytime I get a CEO or a founder of this caliber, I just keep going and going and going. So I had to split this episode. I hope you liked the first part. I thought it was fascinating to hear his pivot from SaaS into an agency business. I talked to a lot of founders that wish that they were a SaaS or software business. Also, a lot of focus on the long-term vision when they were selecting a PE partner. I thought that was very interesting to tell. So in part two is going to be terrific. Part two, I think you'll enjoy comments. Justin talks about what some of the biggest concerns were. And how, from the buyer's perspective, the private equity group, Insignia Capital, and how they structured the transaction so they could mitigate some of those concerns. Also, very interesting, his insights, and kind of takes us behind the scenes of board meetings and what those are like and how they accomplish them in a really successful business. And a lot of his perspective looking at the next 3 years, what they're thinking about for M&A, which you might find interesting, and also how they plan to integrate those businesses. So definitely want to make sure that you spend some time on episode 2. I think you'll find it just as interesting as we know.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.